Welcome to Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland.
And I'm Mike Alexander.
Well, Mike, you can't turn the TV on, you can't turn on the radio without hearing something about some political ad or the election that's coming up. Politics, there's not a client conversation we don't have that they don't ask about the election. Do elections matter to the market?
So the short answer is no. Historically, who's in office really hasn't mattered that much as it relates to markets. Now, if you want to add to that, you can always say that it matters as it relates to sentiment. It matters in terms of what, the type of news coverage that you're likely to get. But historically, markets really haven't cared who's in office. The only thing they really want to know is what the rules are. And so once that's kind of figured out, markets tend to behave on their own based on a host of other inputs, if you will. So whether it's earnings growth, interest rates, so on and so forth.
What's so interesting, and let's dig into this a little bit, right, is that in conversations that we're having with clients, one of the things in listening to you speak that kind of hits me is that without regard to what side of the aisle you're on, or even if you're on a side, right? Because here's what reality is. There's in the 20s that identify as Republicans. There's in the 20s that identify as Democrat. It's that middle. Most people consider themselves to be in the middle. I think what ends up happening in relation to the markets, who's in the White House becomes much more emotional and becomes much more of a behavioral finance. You agree with that?
I do. I think people tend to vote with their wallet, and sometimes, who's in office drives a lot of that sentiment. If your person happens to be, in control in the White House or in control as it relates to Congress, maybe you feel better about your job. Maybe you feel better about spending. Maybe you feel better about taxes. So there's definitely an emotional aspect to that. I think one of the things that we found is that, as Mark Twain said, history doesn't always repeat, but it often rhymes. And so, what I would say is that we at least have some history as to how markets tend to behave given certain scenarios. So, we've got history going back quite some time that just indicate that, when a certain situation unfolds, we have some history in terms of actually how markets have done. And by and large, remember that most of the time markets are going up. So, you typically always have a better than 50% chance of markets going up, no matter who's in the White House. But we do have some data that suggests that markets tend to do better in 1 year of a presidential cycle versus another year.
So we understand that the fourth year of a presidential election year is the second best. Pretty good year. After we've gone through this, and now we're in this right here. Is there any other sort of history that kind of gives us a glimpse into maybe what we can expect this year?
Yeah, so it's always hard to forecast markets, but one of the things that we do know from history, and that this is going back to 1952, is that anytime we've had an incumbent running for office or running for the presidency, the market has been positive. So we also know that whenever we've had an open election, which means you have they've already exhausted their ability to run for office again. We also know that every one of those times the markets has been negative. So when you think about it, I think this year maybe it's a little bit interesting just because of Biden and and his age and obviously there's a lot of back and forth as to whether or not he's going to run, whether he should run, all of these types of things.
Right, and at the time that we're recording this, he is running.
Right? Yeah, he is running. Yes, at the time of this recording, for sure.
So, what should we expect? I mean, by the way, let me back up. it's pretty interesting when you go back all the way to 1952, there were only 3 times that we didn't have an incumbent run. That's surprising, right? And I think it's really important also to point out that just because an incumbent is running doesn't mean they win, right? So there's a little bit. So that's maybe that kind of explains why there was only 3 times when we didn't have an incumbent.
Yeah, they don't have to necessarily win, but I do think the market likes the stability of knowing, hey, I know what I've got here, and there's a certain amount of stability, whether somebody likes the candidate or not. It's kind of like, again, back to the, at least I know what the rules are.
Yeah, and I think that's, the markets hate uncertainty, right? And when you have 2 different brand new people running for office, there's some uncertainty that's in there. And just like when you talked about, what's more important is whether or not it's a unified government. In other words, the White House is the same party as the Congress as well as the Senate. That is a different story than when it's divided.
Yeah, absolutely. It's investors typically like divided government, because what it typically means is that you do not see extremes one way or the other, and there at some point has to be some level of compromise, some level of back and forth. And so what it really means is that there's typically a bit more stability. Now, I understand that in recent years, and particularly with news coverage, that it's a lot more it's a lot more, let's just say, heated in terms of the debate. But markets typically can brush that aside, and divided government is something that they've typically liked, and we tend to get the best performance out of markets when you have that divided government. When you have a situation where there's a stalemate, if you will.
Yeah, nothing's going to happen.
And nothing too severe is really happening. And so markets tend to like that a lot.
One of the things that I think people really want to know, and we've talked a lot about this, in an election year, it seems like there can be a lot of volatility. And some of the things that I've kind of looked at is that, and as we've told our clients, this year is going to be a bucking bull, right? Market's still, the trend's going to be positive, but it's going to be bucking. Talk a little bit about kind of timing, some of the things we're paying attention to when it comes to volatility in this market. Which is
so there's a couple of things going on as it relates to volatility. I think first and foremost, just think about where we are in terms of the Fed policy cycle, if you will. So we went through this long period of interest rates being low, practically at zero, across the board. And so we had very, very low interest rates. And then that gave way to a period where rates rose significantly over a fairly short period of time. And now we've kind of come to the end of that cycle. So I think you have that part kind of juxtaposing with what's happening in politics as well. And so, but what we typically would see is we would see an elevation of volatility around your data points, but you typically see elevation of volatility as we head into that full-blown election season. Now, one thing as of this recording is that it's, maybe earlier than normal, we're going to know who the candidates are. And so if you go by history, you typically will see about a 30% increase in volatility for the S&P 500 for that 5-month period before the election.
Which is generally when the conventions are and it's all decided, right? So that makes sense.
And now, so this year it might be a little bit interesting. We might see elevated volatility maybe earlier, because I think there's a good chance we're going to know who the candidates are earlier. And so I think it's just something that, if there's going to be something that's different this time, it certainly could be that.
So what are the, we talk about this inverted yield curve, which is the environment that we're in, this inverted yield curve, which is where when you invest in a short-term bond, the interest rates on that are higher than that of a long-term bond, which is the opposite of what you think. If you're going to tie money up investing in a bond in 30 years, you want to be paid more than one that you're going to be invested for 3 months, right? So we've had this inverted yield curve. inverted yield curves, and maybe that I don't want to get into yield curve and all that kind of conversation right here, but a lot of talk, and it's picked up at the end of last year and so far this year, is about the probability of a recession. Specifically, what are the odds about a recession happening in the fourth year of a presidential election term?
So of the 4 years in a presidential cycle, it's the fourth year that is the second most likely to actually see a recession. So it's kind of interesting that, we had a lot of banter about that last year, and really maybe even going back over the last couple of years. But I think, as we've talked about in previous podcasts, Robert, there are many parts of the marketplace, if you will, that perhaps have been in a rolling recession, if you will. And so think about all of the negative news that we heard about retailers and areas of the marketplace. So
housing.
Yeah, housing. We've definitely seen some of these parts of the marketplace that have kind of rolled through that. We've got recessions occurring in Europe already. And so I think there's definitely some concern that that perhaps the Fed will keep rates higher for longer than they should. We certainly have had a lot of rate cutting priced into the marketplace already, and certainly that could lead to an elevated level of volatility. The fact that it's actually might occur in the fourth year of a presidential cycle, I think probably weighs on some investors' minds, but maybe different than in previous recessions. The average consumer is on pretty good footing. The housing market is actually on pretty good footing. And there remains a tremendous amount of liquidity out in the marketplace as well. Again, about $5.5 trillion that's just sitting in money markets. So, just as it relates to, investors and performance, there's plenty of, dry powder, if you will, that could come in off the sidelines if we were to see that elevated level of volatility.
Well, don't you think this is something that I've always found that's absolutely amazing? By the time that the government comes out and tells us we're in a recession, we're already smack dab in the middle and have been in that recession for some time. And by the way, we obviously, the classic tradition where that I was trained on and you were trained on, the definition of a recession has changed. It used to be back-to-back quarters of negative GDP growth, and that changed. But what's interesting is that about the time that they come out and announce, generally speaking, you're about halfway through, and the markets have already started to recover. I think really the point when you're thinking about your investments, thinking about your financial future, is the markets and the economy are not necessarily the same thing. The economy and the numbers that we get are all backwards looking. That's where we've been. If we try to get from here to San Antonio by looking just in our rearview mirror, that's going to be a disastrous trip. May not be successful. But the markets tend to be forward looking, paying attention to where the trends are, paying attention to what's the fundamentals of companies, paying attention to the technical analysis, paying attention to market share, profitability, all of these things. That's what the market's after. And the markets always end up going up, generally about halfway through a recession. And recessions are relatively short-lived. So, Mike, with all that, to kind of put a bow on this, we're not far. It seems like a long ways, but we're not far away from actual election. I think most people will be thankful to get that box checked and over with, right? Be done with the political ads and everything that's inside there. What should people be doing?
So a couple of things. Just remember that, this particular political season, again, could be a little bit longer. And so it's going to, it may take a little bit of turning the TV off along the way. But I think from an investor perspective, it would just be recognize that volatility may be elevated. That's not necessarily a bad thing. It just, but it can definitely weigh on your psyche. So number one, just recognize that it's likely to occur. Don't panic during those types of periods. It's never paid to panic before. It probably isn't going to pay to panic this time either. Take advantage of some of these potential, drawdowns that you can see in the marketplace. It's a good time to always have, kind of your buy list of things that you might want to, own going forward. That's certainly something that we do. And certainly one of the things that we're always keeping our eyes on. Use it as an opportunity to diversify. It's a great opportunity to have the ability to buy some things on sale. It's a great time to be able to find some value in the marketplace. I think one of the things that we have to keep in mind is that even during this, the stealth advance that we saw in 2023, there were broad parts of the marketplace that frankly did not participate.
Right.
Some of those areas are inexpensive relative to the rest of the marketplace and really haven't moved a whole lot off of that. So there's going to be opportunities there. And look, it's a great opportunity to start, to buy things that are, paying you a dividend. And so some of those are areas of the marketplace that again did not participate to a great deal, and they're likely to come for sale.
You said something just a second ago that I think that makes a really good point that should give people, if we go and we look at the trends, fourth year of a presidential election term is generally positive, roughly about 75% or 7.5% return on average. That the longer term, everything is still intact. The American dream's not over, and it doesn't matter who's in the White House. It may matter from a society standpoint, and for what you want to have happen in the American way of life. But at the end of the day, the markets are pretty much agnostic to who's sitting in the White House. They really want gridlock. They really don't want Washington to be able to do anything. They want to know the rules of the game. But the thing that you said that I think should give people a tremendous amount of pause, or make them feel comfortable. Over $5 trillion sitting in money markets. Consumers or individuals, institutions, and corporate balance sheets are flush with cash. Every single time that we have had any sort of pullback or a recession or something like that, what has happened? Well, boom, everything's on sale, and they're just like my wife, and it's an excellent opportunity to go in and buy a lot. Keeping a little bit of powder dry right here. If in fact that happens, know what you're going to go to do. And what ends up happening is that ends up elevating it, and you come out of there in a better shape than when you went in. And I think staying invested, keeping a plan, having dividend paying stocks, being diversified is what's going to help and protect you. If in fact we do have a recession, which we don't, we'll see, we'll know about it after we're already in it. But I think that it's really important to realize that though we spend a lot of time and energy talking about politics, at the end of the day, from a financial standpoint, it really doesn't make that big of a difference. The markets return what the markets return.
That is true, my friend.
Well, with that, I want to say thank you. Thank you to everyone for listening. We hope you found value out of this. Feel free to give us a call. Let us know if you have any questions. We really appreciate it. And I hope you all have a great week. We'll see you next week.
We'll see you next time.